Well, I'm going to take this 25 minutes, to talk about the roadblocks and also the potential solutions, how to link the real world real estate properties and also personal assets to NFT. So everybody is very excited about the NFT development. And I suppose the audience, everybody has a little basic knowledge, about the NFT. So on this screen, as you can see, some of the NFT that we have created, and basically like a giveaway, and then just to try out the idea. However, the platform itself is really for people who want to become a sponsor, trying to provide the NFT to any potential buyer or any potential nonprofit users. And that's what WeCoOwn platform is for. But WeCoOwn is not just geared toward the digital ownership or NFT alone. So I'm going to go through sort of the introduction of what the platform is about. And then from there, we're going to drill down to what are the potential regulatory issues connected to how to market the NFT. Because NFT, most likely will be under the umbrella of investment contract. So most people is anticipating and NFT, whenever you get linked to the real world assets, it's going to be treated as a securities. So before we get to those interesting points, I want to give the audience a little bit introduction about the WeCoOwn platform and what it is and what it is not. So basically, there are three parts of the WeCoOwn platform. As you could imagine, if you just want to start a venture, trying to create a way for people to do the marketing the NFT, but how do you have people to bring in their real world personal assets and real estate property into the platform? So basically, the part one of the WeCoOwn platform is like a traditional, let's say, a property listing site. And people are familiar with Zillow in the US and Redfin, Realtor.com. So if you have a house, you want to sell it, these are the seller listing sites. On the other hand, you would have social networking platforms such as a Facebook, such as LinkedIn. So these are the social networking platform where people can meet. So typically you will have a lot of buyer group. So you call a real estate investor group, for whatever particular special interest group. You say this group want to buy hotels only. This group only want to buy Airbnb rentals, or somebody only interested in property in Colorado, in Florida, particular states. So currently, as we speak, and there are seller listing websites, there are also buyer discussion group, let's say a Facebook group or a LinkedIn group, for potential buyer to show people what they're interested in. Then they form a group. They can discuss the merits of all the potential investment opportunity. So currently, these two are disconnected. What the WeCoOwn platform on the part one business is basically bringing in both sides, buyer and seller, to create the world's first two-sided property listing and buyer discussion group. So here's a little bit more explanation about what the WeCoOwn is and what it is not. So as you can see, the first part is basically connecting that social networking group for people to discuss. Let's say here, I see a small hotel in Colorado or in Florida. Who else is interested in this property to co-invest with me? They can actually post a picture or post a link. The link could be from the LoopNet, the commercial property listing site, from a Redfin, if it is a small, residential income property, or from, we have our own seller site that's called We Properties Owner. Now, people was going to ask, well, WeCoOwn, is that only geared toward the rich people? And for example, other than real estate property, you can actually post a yacht. Now, talking about co-ownership, let's say WeCoOwn platform is basically a platform for any potential co-owners. So people's going to say, well, is this site geared toward the rich people? It's not really, because if you look at it that way, let's say a yacht owner, a condo owner in the French Riviera, if they are super billionaires already, they don't need to co-own anything with anybody else. So we co-own from that, sort of a capitalist perspective. It's basically for those middle-class people, the rich people want to be, to enjoy the lifestyle of the super rich, but do not have to really have that kind of wealth capability to do so. So that's one way of looking at it. In reality, that would be the biggest market immediately, a low-hanging fruit, so to speak. On the other hand, the WeCoOwn could be used to democratize and the middle-class income people, so even the less fortunate people in our society. And if you look at it that way, let's say a lot of previous renter, they can never own a piece of the equity for the house that they live in. Now, if they become a co-owner, even though they continue to become the tenant, they can still enjoy the capital appreciation to participate in the wealth building process. Now, if you extrapolate that concept to the extreme, WeCoOwn platform sort of a bridge between the capitalist and the socialist. Because if you push toward the extreme on the other end of the spectrum, the socialism, you can stretch it to a communism, because under a communism, basically everybody co-own everything. Everybody uses and co-own everything. So that's why the WeCoOwn platform could be anything that you want it to be. It's not exclusive just for the rich people. Now, that's enough about the background for the traditional business. The platform basically has three parts. And the first part, as I just previously explained. The second part, we created a reward token. And without going through the ICO and all that, we have the token listed on the exchange, simply just like a frequent user program, like an airline's frequent flyer program. It's called a WCX. It's been traded, on the exchange for over a year already. And of course, the token price has suffered just like everybody else, and during the crypto winter. The third part is actually my focus on my discussion today. That's an optional platform to let people to co-own the either property or yacht, personal assets, or a piece of artwork instead of the traditional ownership. Let's say, what is the most common traditional ownership in the US? So that could be the LLC. Now, the LLC is basically, let me switch back to this site here. The LLC is basically a way for multiple owners to own fractional share of the real estate property or personal assets. Now, with the blockchain technology, all of a sudden that traditional paper co-ownership made possible by the blockchain technology to have a digital ownership. Now, what is the NFT then? What does NFT come into the picture? First of all, the blockchain technology gives people a way to have a verifiable and also transferable digital ownership. Because of that, the unique property that made the cryptocurrency possible, right? The simple concept is basically, what is Bitcoin? What is the other altcoin? Because it's created that digital ownership on the ledger, you can only use it once. You cannot spend the same ownership, whether it's a currency or an asset, twice. So that's what the advantage of blockchain technology provides. Now, once you have the verifiable digital ownership, how do we make the transition from the traditional society? Because all the current legal infrastructure was built on the paper ownership. How do you connect, for example, how do you connect this hotel building or the yacht? Right now, you have a piece of paper. They are not really connected. That piece of paper is not connected to the yacht. or the Van Gogh painting or the hotel at all. It's just under the legal framework people accept. If you have a stamp, if you have a paperwork that prove your ownership. So eventually, no matter how you do it, and that concept will slowly progress into the digital ownership. So the verifiable digital ownership of NFT is a big step forward made possible by the blockchain technology. Even though the current legal framework cannot catch up with it, but sooner or later, that will become a commonplace if we look at a few decades, in the future from now. Okay, so that's basically the background. Now, during that process, how do you actually progress from a paper ownership into a digital ownership? Because in addition to the advantage of a verifiable digital ownership, everybody knows the benefits of the technology. And instead of sending through postal mail of your LLC member interest at the speed of an electron flying in the cyberspace, you get your digital ownership right away. Because of the speed and the other, affiliated technological benefits, that all of a sudden the marketing or the transmission of this digital ownership and will bring in some collateral damage or side effects. That's what people need to address. What I'm referring to is basically the marketing process. So if you market, let's say, a fractional ownership in the traditional sense, in the paperwork, you have the current infrastructure. You got to through an investment bank, broker, dealer to be licensed, to be treated as a security. And then you can actually go through a red herring and then, mail people to the subscription agreement for people to sign up to own a piece of the fractional ownership. But because of the technology, the speed of electron flying in the cyberspace, you can get it right away. You can reach out to much bigger audience than before. So therefore, the marketing of the NFT, that digital, verifiable digital, the ownership, will become a more difficult issue for the regulator to catch up. So before I go to the next slide, and basically I would like to just to show everybody and what is the site is about. I have to switch back to other side here. So it's a glimpse of the site and where you have all different type of personal assets, real estate, yachts. Now, speaking about yacht, and I myself being involved because of these projects I've been working on for almost 2 decades now, on and off. So currently, I've been a practitioner of a real estate brokerage, a yacht brokerage, and art dealership. But among all the co-ownership, people are familiar with the concept. Let's say if you own Airbnb rental home, that's small amount. That's $1 million, $2 million. Many people can afford it. But if you're talking about a hotel, 20 million, 30 million, usually people need to use a syndication. So that syndication, a private limited partnership ownership, that's a fractional share. So that fractional share, or in the old days, people use the TIC, taking common, and it's already been practiced for decades. People are familiar with it. But if you extend it to particular personal assets, such as a yacht, such as an art, that's a little bit new concept to many people. But I have to say, among all the potential fractional share ownership, real estate, yachts, jets, art, the yacht is a perfect example. Think about it. For a 60-foot yacht, you spend $1 million, $2 million to own it. You have to ask the owner, how often and how long are you going to use the yacht, right? So that is basically, you would say, okay, 3 months out of the year. But for the 3 months out of the year, why don't you just own it with three other people? 4 person own a quarter each. Then one person can use it from January to March, and another person use September to December. So that's a perfect example for co-ownership. Anyway, so this is just to show you, what is on the buyer side, and people can put in all the different assets, that including crypto assets and NFT. So it's a platform for anybody If you're a sponsor, you say, I have the ability to create NFT, I want to market it to other people. This is a platform for you to come to. Instead of, let's say, Pacasa used to use Facebook to market their fractional ownership. This will be a dedicated Facebook or LinkedIn for buyer and seller of personal assets in real estate property, dedicated. So the audience is not somebody who is disinterested in any property investment or whatever. So I also mentioned there's a seller side, that's a wepropertiesowner.com. So this will basically allow sellers to list their property. And the previous one is basically for the buyer to discuss any potential investment and finding like-minded co-owners with them. And this is basically just for the seller. And whatever you have property, like LoopNet, like a Zillow or Redfin. Now, of course, once you purchase the yacht, how do you manage it? You will have a SaaS tool, and to say how do you actually take the rental income and distribute it to the co-owner. And lastly, this is just a glance through everything. This is where the token side of the WCX. And there's a white paper here. People can actually take a look at it. So I'm going to jump back into the next page. Okay, so now let's take a look at it. How are we going to allow many sponsors on the platform to really successfully market their fractional share in the form of NFT? Now, before we get into that discussion, we need to review a little bit about the current. When I say current, it started in 1933. And or later on, there's a landmark case of 1946. It's called a Howey test. So that basically will give people the, let me just try to get back to my previous slides. Okay. So what the Howey test is basically trying to find out whether you are selling is the investment contract or a security. Now, it's very simple. Whenever a buyer, and before you even call it a buyer and investor, you say, are you actually buying this using a currency? That's number one. And number two, are you buying into a common enterprise? What is a common enterprise? This could be a LLC, could be a corporation, could be a stock certificate of a company listed in the stock exchange. The third criteria is whether you're making this investment and with a motivation of making more money. So these three criteria apply to the majority of the reason why people make an investment. The fourth item, that's the most important part. It's basically saying this investment you're buying into, the way for you to make money in the future, will that depend on somebody else's efforts? So this is referring to a lot of promoters, entrepreneurs, very enterprising entrepreneurs trying to promote something. So based on the four simple concepts, let's take a look at it. And which one applies, which one doesn't apply. Then you will have a better understanding of the landscape of potentially marketing fractional share NFT. Because remember, the potential NFT is huge. The potential of NFT is to replace the role of a paper documentation for any ownership. Therefore, in the future, that NFT as a form of verifiable digital ownership can apply to almost everything in the world under the sky and or beyond Earth. Even if you own a piece of the moon or Mars, you could mint the NFT and to claim I have that digital ownership, and you can sell it, you can transfer it. Okay, so with that as a background, let's take a look at it. Why, when the NFT started, it applies to artwork. Why the digital art is actually on the rage, and spread everywhere. people making a lot of money and lost a lot of money in the collapse. So there's a reason to it. Before the NFT, before the digital ownership, let's take a look at it. Even art is not considered a security. We think real estate, also a single family home. If you want to buy that home to live in there yourself, no matter how you market it, your real estate broker, agent market it, it's not considered security. Why? Let's take a look at the criteria. First of all, you're using your US dollar to buy that artwork, okay? Then you're not going through a common enterprise. Even Beeple, sold his artwork for close to $70 million. So it's created by him himself. Then whether people invest in art with expectation of appreciation, there could be, but the majority of them simply just enjoy, as people say, the beauty is in the eyes of the beholders. So art has a special status. So you may not buy art just for the potential appreciation purpose. Of course you could. Thirdly, that's most important. If you say an artist created a piece of artwork, but there's no promotion, there's no third party or enterprise trying to promote it, okay? So that's traditionally, if you're buying into art, it's not considered security. Now, I'm going to also take you quickly through the real estate concept. So as I mentioned before, people use LLC, use a limited partnership to do syndication. Let's say I sign a contract, I secure as a buyer the potential purchase of a particular property. Then I form a limited partnership to raise money from the investors, okay? So that is definitely selling a security, especially as I mentioned, office building, industrial warehouse, or hotel. It's all done in majority through this way, which is very different from just buying a house for yourself, or even if you want to just rent it out through Airbnb. Why? Let's take a look at the criteria. Number one, you're using a US dollar to buy that house in the Bay Area, in Palo Alto. So then the money is not in the common enterprise. You're buying it from the previous owner. Thirdly, your money paid and with expectation of profit return. Okay, yeah, other than just living in the house for yourself to have a shelter. Of course, everybody wants the real estate to appreciate. But fourthly, that's the most important criteria, because you buy a single family house, a way for the real estate to appreciate is without anybody's efforts. You could improve the property by putting some renovation, the upkeep of the property. But in general, the real estate appreciation is by the market. So that's why people trying to apply this concept to Bitcoin, and they say, well, Bitcoin is fully decentralized. Well, that's a different topic. I may get the time to address that concept later. But just based on applying these four criteria, you can determine roughly whether the SEC or regulator in other country, they will get to you. Now, regarding that, that's why if you look at the difference between a residential single-family home and buying as a co-owner for a hotel, it's very different. So the yachts apply to the same thing. In the past, traditionally, the regulator have not really treated the co-ownership of a yacht as a security. But of course, that would determine how you market it as well. Do you market it in private, or do you market it and in a public offering? So in any case, let's take a look at it. When you apply to NFT, why does that matter now? Because I use the example of Beeple, right? It's just one solo artist created artwork. They sold it for himself through a traditional art house. So there's no doubt, I don't think in the near future SEC gonna, get to Beeple. But if you look at right now, there's a lot of other enterprise, right, and the company trying to create a lot of picture of an animal, could be any kind of animal stuff. Then people who invest in their digital currency, right, in Bitcoin, Ether, and they do have a company to organize and create all these type of NFT. So the people who invested in all this, I don't think, a lot of them really just have a JPG file, and they think, it's a beautiful. They want to just to keep staring at it. So people make the investment, and the majority of them wanted to make a profit, and a trading profit, if not just investment profit. Fourthly, that's the most important again, and whether that potential effort is from the efforts of other people. So those sponsors, that's what I call it, whether it's an animal picture, or you want to apply it to somebody who want to sell a yacht, or link into a real traditional artwork like a Van Gogh or something. Then that company, they will have an organized team to do the promotion. And that's where it coming to the more difficult part, And all of a sudden, the 4 criteria apply to those type of NFT. So that's just a general understanding, background understanding. Now, when you extend from selling a digital art NFT into link up to the real world, voila, all of a sudden you're selling fractional share NFT of a real estate property, of artwork. Even though, as I said, in the traditional sense, your residential single-family home, if you sell it as a whole, it's not a security for sure. If you sell a piece of Van Gogh, it's not a security for sure, Sell it to a museum or do whatever. But once you have a fractional share concept, you cannot avoid it. That will have a common enterprise with a group of people dedicated to promoting it, pumping it, for you to increase the value. That's why as we progress, as the NFT get to link to the real world real estate property or personal assets, eventually you won't be able to get away with that. Now, if I draw this, sort of analogy just for you to take back of the recent history to understand and the process. For example, with the internet, you have the ability to access a lot of people, also with the digital speed of electron flying, So you can reach out to a lot of people. So the first wave is really the 2010 crowdfunding concept. When that chapter first started, a lot of people felt, oh, wow, very inspired. This is great, So there will be a lot of young people, and without, enough legal background or banking the experiences, so rush to create a digital venture, The second wave is really the 2017 ICO, when you have the digital currency. Anybody can create a currency, a token. Then you do the pump, on the internet, and much easier for people to go through. Crowdfunding, you still have to go through the paperwork, all the subscription statement, blah, blah, blah. All of a sudden, the paper-based ownership became digital through the 2017 ICO. So that's really adding fuel to the fire. Now, once you get to that stage, as you can see, the potential, the regulatory issue, and most of them just threw it out of the window. But the thing is, this interesting perspective. If somebody got enough VC money backing to go ahead and sell it, it doesn't really matter whether it's going to be treated as a security or not. So if you're a small project, you achieve the success of 10 million, 20 million of your venture, then you're going to be doomed. It's just a matter of time when the regulator going to come to you. But if you actually, with enough backing, enough money, all of a sudden you create a unicorn. Now, all of a sudden, even when the regulator catch up later, years later, when they get to you, these unicorns can probably hire better attorney to fight the SEC using taxpayers' money, and then they will make it. So even if you make it, then whatever they have done will be grandfathered in. So that's just a little bit the philosophical perspective, how you handle this. But that's definitely not the way, and we would recommend any sponsor on our platform to do it. We will advise, that's why we spend a lot of the legwork trying to create the infrastructure for a lot of the sponsor. When I say sponsor, basically those people who have, I'm trying to get back to this, okay? And those people who have an NFT, they want to market to the security. So before I get to on the platform, how we actually help the sponsor to market their fractional share NFT, I want to introduce another concept that's very unique on the WeCoOwn platform. So on the WeCoOwn platform, there's a unique situation. Unlike all the crowdfunding, real estate crowdfunding or whatever, whether you use a traditional ownership, paper ownership, or use the digital ownership of an NFT, it's always like a sponsor. Let's say you buy this office building, you buy this hotel, then you mint an NFT, you created an NFT, then you need to look for investor, people with money to invest, to buy your NFT. That, as I said, from 2010 crowdfunding, 2017 ICO, that's going to be treated as a security. There's no other way around it. However, if you look at what we have built in the part one on the WeCoOwn platform, that will create a different scenario. Let's use just a yacht owner or a hotel owner. Let me use a yacht owner to begin with. So let's say 4 person, they meet each other. Somebody posted a picture of the yacht, or from the listing of WePropertiesOwner.com site, a seller trying to sell the yacht. He posted on the WeCoOwn site to say, hey, anybody else interested in this yacht? Anybody else want to buy it together with me? So then he got 10 of them interested, and he ended up with 3 other people. So the 4 people, they met, and with the goal trying to co-purchase the yacht together. During that time, no money changed hands. Nobody's promoting anything. All 4 members are equally treated. They pull the money together. Then they actually go to the seller as one of the leader of the group, and then makes a purchase. Once they purchase it, they can decide, instead of the LLC paper ownership, I would like to put my yacht as a digital ownership. So potentially I can sell it to somebody else, or for me to manage the ownership online using the PBMS on the platform. If I don't use my 3 months quota of this yacht, I can rent it out, I charter it out, I will generate income. So you can on the platform to manage all the cash flow without that convenience. So this way, the 4 people meet before they even mint the NFT. That's what we would like to call it, a type 1 NFT minting, which is a pre-NFT buyer ready token minting. Meaning before you mint the NFT already, you already got the 4 buyer ready to purchase the personal assets or real estate property. That's something unique, only happen in the platform. That's why we spend so much investment and time trying to build a platform for the traditional world. Versus the second type, which is actually most people see in the cyberspace. The majority of the sponsor is going to say, well, we hired enough smart programmer, we can mint NFT. So now we actually identify a single family home or a hotel. We're going to do the world's first experiment. We're going to mint an NFT. Then they turn around trying to look for other investor, buyer of their NFT. All these belong to the concept of crowdfunding. So we have the Jobs Act for CF, the Reg CF, you can raise up to 5 million. For Reg A, you can raise up to 75 million. So the infrastructure already set up. All these are treated as a security. You should simply follow the rule to market underneath a broker-dealer. That's the term in the US called an investment bank. And there's basically rules and regulation how you market it, all that. So being treated as a security is not the end of the world. All you need to do, if you care about long-term success versus a short-term, pump and dump type of a venture, that's what most sponsors should be aiming for. So that's basically the key concept. That's why we're trying to create all the infrastructure. For those people interested in the topic, you can go to a detailed blog post regarding this regulatory issue for Frac-NFT and how we propose to solve the problem for sponsors remember, we are just a platform. We may or may not be a sponsor ourselves. So that's basically the concept of how to potentially market the NFT as a security for the long-term success. And here's another interesting previous video that I discussed on the YouTube. So it's called a fractional share. Fractional share NFT and how to link them with physical assets. Okay, so there's a lot of information you can follow up with it. And then, as I said, we created all this. There's a lot more detail, and the currency is already floated, on the exchange. And but this is not the how we trying to market it. That's a totally different topic, not NFT. But basically, we created this as a potential utility token for people to pay for the subscription fee. The vendor, real estate broker, yacht broker, you need to promote your service. The seller, you listed your assets on wepropertiesowner.com for free. But if you need to promote it, you can use the token to pay for all that. And lastly, as I mentioned, we had a whole series of NFT, and it's on OpenSea. And for those interested, who can take a look at the NFT that we have. But the purpose of the NFT is for us to sort of as an airdrop, and give away a lot of the token. So if you purchase one of the NFT for a small amount, you will get 10,000 WCX token for free. So that concludes my presentation. And